I'm Doug MacKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody.
Hello, everyone. Thanks for listening. How you doing, Doug?
Just enjoying being semi-snowed in.
Yeah. It is kind of nice, right? It is peaceful in some ways, right? It can be stressful when you got to drive in it, which I know you have recently, and so have I.
Yeah, I went out. I had to go relatively farther north from where I am, and I decided to go up last night, and the roads weren't terrible here. So for anyone listening, we're in New Hampshire, southern New Hampshire, and I had to go up to Vermont, and I was like an hour into my drive on the highway, and I knew that I had made a mistake.
And how much further did you have to go?
Like 2 hours.
Oh, geez, yeah.
So
there's no turning back. You're in the middle of no man's land.
Yeah, I was on the middle of 89. It was just, you couldn't see anything. They hadn't really plowed the highways at all. But it's funny, we got away with having no snow until January, and then we got a bunch about, a week ago, and then we got a bunch of rain, so it all melted, and then we got some more. So that's our life lately.
Yeah, and it's sticking around because we're not getting over freezing right now. So
no, now it's cold.
Yeah.
For us, I'm sure that we have people like listening in Minnesota or something.
Yeah. You don't feel bad for us, probably.
No.
And I speak of my brother who lives in Iowa, and he's been out there for 20 years, and he just got two in the last week. They got two back-to-back foot of snow. So, and he says that's the most they've ever received there.
Really?
Well, he's lived there in 20 years. Yeah. And I know it was, I think the wind chill, I'm pretty sure it was like 30 or 40 below.
Yeah, that's terrible.
Yeah. So, but he sent a picture of his fireplace. So that was going.
He was cranking that.
Yeah, a gas stove kind of thing. So, it's not like he was shooting it up the chimney in an open air fire pit. But, so he's warm and everything. But, yeah. So I think we're getting a bunch of that across the country. Well, I'm glad you made it. I'm sure it was a bit of white knuckling like I did in the morning yesterday. I went out in the morning, and that's when it decided to snow. And so, yeah. It's just, some people are very, very confident, and I think I used to be more confident. Maybe I had snow tires then, and I'm not using snow tires now. But I just think, it's so easy. If you've ever slid on ice, icy roads, you find out how quick that takes over, right? It's part of nature. It's kind of like the ocean and the wind and all that kind of stuff. Ice is unforgiving in a way because it happens so fast, and you really don't always have a chance to correct, because it's just taken the car and sent it and spun it around. And if you're on the highway, just about anything can happen.
You're off in a ditch.
Well, you can get smacked by somebody. Yeah, because everybody's going at different speeds and different comforts, they think, but they don't know what what might happen with the other guys. So enough of that, I guess. But again,
we digress. It's all right.
Yeah, I'm glad you made it, and
me too. Otherwise, we would.
Hi to my client who I met, and it was well worth it. Just so you know, Lucas, it was great to see you. So thank you. I wanted, it's just something that is struck me many times, when you talk to people, because yes, we try to say that, you're building this capital pool, which you are, and, you don't have access to every dollar you put in, say day one or year one, to leverage, to borrow against and do infinite banking. But let's just say in most cases you have at least half of what you put in. And I kind of, just played with some numbers, and, someone puts in 20 grand and they have, let's just say they had access to, uh, say 10 grand of it to leverage. Well, then there's 10 that's gone to work. And where is that other 10 gone to, right? It feels like an expense. And it is, right? Because, you bought something, and so what I'm trying to say is I want to, talk a little bit more about something we don't talk about much. We mention it, but death benefit.
Mm.
And the fact is, in this kind of hypothetical situation, it depends. The younger you are, the bigger that number gets, the death benefit number gets, with the same type of premium that an older person would put if they put the same, say, 20 grand in. But we could take a sort of a
Just
40.
for anyone listening, really quick, if you're new to our show and you don't know what John meant by that, if you use $20,000 to buy, a year to buy a life insurance contract when you're 18 versus if you're 56, you're going to buy a lot less death benefit for the same amount of premium when you're 56, just because actuarially you are much more likely to die. Not to sound morbid, but you just are. So every year that you get older, life insurance becomes more expensive to buy the same amount of death benefit.
Right, exactly. Thanks, Doug. Yeah,
So sorry, keep going, John.
no, you articulated that
Yeah.
well, so thank you. And so from there, when people are looking at it and going, wow, for me to sort of give up 20, well, I'm saying, well, yeah, but let's just say you've got access to 10 of it right away, thereabouts, right? And the amount year one of the other 10, yeah, you bought this asset and it's a life insurance policy, but it also is an asset that you're building this banking system, right? As Nelson Nash says, you're starting a new business from scratch when you sign the agreement to take this policy, right? To put this policy into force. But the example is, say, year one, that 10 that you don't have access to just bought an asset, say, of like 375,000. And if you turn that into a multiple, obviously it's 37 and a half times what you put in. So if you do happen to die, well, then you've kind of already guaranteed this, for lack of a better term, maybe a lottery ticket for your family, right? For your loved ones. And of course, I want to emphasize that each year, as you progress in your premium payments, you have more and more access to the 20 that you're putting in this example. Let's just say it could be, the second year is 12, it goes to 15, till eventually, around year 6, 7, again, depending on who you are, what age, um, how it's structured, but somewhere between years 6 and 8, every dollar you put in, let's just say year 6, you have access to all the money that you put in every year, because you're, as it stands, if dividends stayed the same, again, historical lows, so probably going to be the same or higher. And if it just stayed the same, the year that you put in your premium of 20 and it's year 6, and now your net cash value increases more than the 20 and continues to grow every year, I can tell you it's worth, 500,000. Again, just a hypothetical, but it's worth 500,000 plus. It's like 34 times what you don't have access to, because in year 6, if you're putting in 20, you've put in 120. Let's just say it was 105,000 is what you have in net cash value that you can leverage, which leaves you with 15 that you still don't have access to yet. But that 15, if you die, turns into over 500,000, and that's like 34 times as much. And I also, so I'll go back to this first year at 37 and a half, Doug, and I'll use the year 6 when I call it dollar for dollar, meaning what you put in for your premium, your net cash value is growing by that amount or more. But I look at it like, okay, I've had access to the money throughout those 6 years. I didn't not have access continually. I could be taking it out. I could be, acquiring something. I could be putting money back
You
in. I
could
could take
already be generating a rate of return outside of the policy with like a good amount of money.
exactly.
Yeah.
And so, yeah, when you look at it in terms of, hey, I want to put this into percentage terms, right? Because the world in finances likes to talk about percentages. And we're talking about,
Percentage, rate of return.
yeah, we're talking about, say, the stock market, let's, whatever number, just recent podcast we were talking about, this 8 to 12, or I said 2 to 12, or, over a span of time.
So I see different numbers on that, but I think the figures that I like the most, of course, it really depends on which decades you choose to start from and end at. That's the real kind of kicker. But if you look at the best data that I've found, inflation adjusted, the S&P, if you start measuring like in let's say the 20s and end today, it's somewhere between like high 6 to mid 7% rate of return.
Okay.
And okay, so and again, anybody can go look at different data points and come up with a different number. If you go kind of end, like if you start in 1930, is going to be higher because of how much it fell in 1929. If you cut out certain parts, it'll be higher. But I think that from what I've seen, that makes the most sense, and that is going to be like a greater internal rate of return, albeit with a lot more ups and downs than you would get on an insurance policy, right? And John and I were talking about this before. I think one of the things that's hard to surpass sometimes when talking with people who have never really thought outside the box of investing in the traditional sense, putting money in a brokerage account, a 401k, an IRA, people tend to think about everything in terms of rate of return. Well, how quickly is this going to grow? What's this going to get me? So first of all, as we've talked about previously, that is not the correct way to think about an insurance contract. Nelson is very clear that this is not about rates of return. This is about growing your line of credit so that you can be your own bank. You can have access to liquid capital. And it just does so very steadily and peacefully in the background. But John's point, which I really liked the idea for this episode, is okay, if you want to talk about rate of return, if that's really what we want to focus on, and you're really heavily focused on the earlier years where you might not have as much money as you put in, and we factor in the death benefit, just like John was saying, if you've paid 1 year's premium payment and then you, God forbid, pass away, your family is going to be left with a rate of return that is in the thousands to tens of thousands of percent. And we did the math out on this. It really depends on, when you've started your policy, because that discrepancy is greater when you're younger and not quite as big when you're older, but it's really substantial. So if you had taken $15,000 when you're 18 and you pass away and your family gets $1 million. Well, that's very nice for your family. If you'd put in $15,000 in an S&P fund and you pass away, your family would have $15,000, give or take whatever it did for
Right.
a few months. So it's just a drastically different financial instrument.
It is.
Yeah,
And
totally.
so back to your point about, this whole point about percentages and rate of return, a lot of people tell me they're not good at math, right? And, you can say 37 and a half times, what you don't have access to leverage in that first year. Like I said, you've got access to say 10, but the other 10 out of the 20, what do I get for it? Well, if you die, your family gets 375,000, and that's again 37 and a half times what you didn't have access to, because they could still be benefiting if you leverage that 10 plus, right? They've got a loan out or whatever, and with the insurance company. But let's just say, put that into percentages. That's 3,750%. And we're talking about, putting your money away for, 30, 40 years and sometimes more, right? Into a place where if you got 7% over that long period of time, you'd say, okay, that grew, right? That was good. It was maybe stressful because to get that 7%, there was years where you were like, oh my gosh. There was years you were so elated, it was so great, and other years you're like, oh, I just lost 30%.
Right.
And I lost 30%, on a pretty big number, right? Like, how much are you willing to lose? But back to this idea, hey, we're talking about real dollars here that would positively affect your family if you died. But let's hope you live a long time, and that's why you started this policy, not so that you can die young. It was so that you could create this banking system that you weren't beholden to the commercial banks, that you had your own capital pool. You were going to do things in life, but you don't have to go to them. You don't have to have a job. You don't have to have a credit score of a particular number. You don't have to set yourself in stone on what you're going to pay back and how often and how much. I mean, you have like all the stuff we talked about. And so you're not giving up, you're not getting nothing for the money that you don't have access to. You have some protection, but you've bought this asset that is going to be ever growing, this asset that will naturally grow, right?
Naturally grow and will really substantially be growing, decades into having the policy.
Yeah, it's guaranteed. There's a guarantee growth, right?
And the non-guaranteed aspect of it is a much more probable thing. I like the word probable there. I was trying to come up with the right word that wouldn't get me in trouble. A much more probable thing than really anything else that I can think of in terms of instruments that can make you money.
That's true. Yep.
The other thing that I'd like to mention, and I don't know if most people listening are aware of this, the vast majority of the people that invest in, let's say, an S&P 500 index fund via qualified plan or a brokerage account, they do not achieve the historical averages that are shown, because in order to do that, you tend to have to be invested over very long periods of time. People become very emotional when they see their account balances, skyrocketing, then dropping 30%, like John said. So a lot of people don't stay in it for the long term. They pull their money out, they get freaked out, or they go think that they watch the stock market go up like 40%, over the last year, and they want to get in on it. So they put a bunch of money in and then it goes down. So then they sell. Psychologically, a lot of people have issues adhering for a long period of time. I know I did. And then The other thing too is when you look at retirement accounts, a lot of people don't actually hold their money in those until retirement. They might leave their job, they might then pull the money out, have it go into an IRA, pay a penalty. Because again, a lot of people need money now. It's like it's a normal thing to need the money that you've been working for. And so again, they interrupt that compounding process. Whereas with a whole life policy, it compounds beautifully every year, and you don't lose that. You have access to it immediately. Like John said, you have access to a very good percentage of it the first year. Every year after that, it just grows until, in the grand scheme of things, pretty quickly, it's going to exceed any amount of premium that you've actually paid into it. So the rate of return, when you look at it with a whole life policy, is pretty good if you factor in people's ability to adhere to a long-term plan. I mean, that's one of the really nice things about an insurance contract is it's like forced adherence. And because it's not volatile, it's really a lot easier for people to pay premium payments in the long run than it is to, throw money into something that they have to watch fluctuate constantly.
Yeah, great points. Doug. I would say it's kind of a forced savings, and the fact is, for the most part, in qualified plans like 401ks and IRAs, that's pretty much the only savings really that people have. Now they might have some extra cash in the bank at the end of the month, but for the most part, Americans, anyways, they spend everything, right? And if they're, and of course, you could say, well, your 401k is a forced savings. But because of the one thing you said, which, and it covers both sides of it, right? Is, hey, that is my only extra cash if something happens in life that I need cash, right? I need more than I have in my biweekly uh, paycheck. I need some lump sum. Where am I going to get it? Pretty much the only place is the only place you've been saving.
Yep.
And you so that's one way that they don't stick with it long term. Obviously, if you have it in a policy and it's a forced savings, your savings does not get touched. Your savings keeps growing.
Yep.
But you do use that as leverage to borrow against it, use it as collateral. And the other side for me, Doug, is over the years, I've known many people in my generation, anyways, peers, that they had a dream of owning their own business. And they got tired of doing what they were doing. They made money doing it, but they didn't love it, right? It wasn't their passion. And how do you get a business started? It's so hard to get anybody to lend you money when you've got no assets, right? You got no collateral for the bank, um, other than you have this qualified plan, this 401k, these things that are supposed to be for retirement, and you're going to be penalized if you take it out before 59 and a half. You're going to pay the taxes, and now you're paying taxes on a bigger number. So there's all this stuff that happens, but it's the only way. I've seen people literally tap it out, right? They think of, okay, this business is got to make it because I've just drained all my retirement savings, or my retirement investing is what I would call it, because it is investing. You put, unless it's in money markets, it's exposed as an investment, which means it could be lost, right? It's not savings that's locked in, but you put it into a permanent whole life policy like we structure for people, that savings never diminishes. It never goes down. It only grows. And so I say you catch it on both ends. Whether you are doing well, so to speak, in life, you've done well in the market, or hey, and everything's going swimmingly in your life otherwise, But then the other extreme is, hey, I'm in need of a lump sum of cash, and the only place I have it, let's just big enough number, whatever that number is for somebody, and they need it. They got to go take it out of their qualified plan because they don't have a stash anywhere else.
Exactly. Yeah. And so I'd much rather have my go-to spot be something that's liquid that I can pay back on my own terms, and I'm not going to be interrupting the compounding process, because your rate of return becomes pretty bad when you take your money out of anything.
Yeah. Well,
So
yeah.
again, I think a lot of people like to kind of almost fantasize and put things in very like, oh, well, if I just do this for the rest of my life, I'll do this. I'll get this rate of return, right? That's rarely how it goes for people. Life events pop up, priorities change, the ways that people want to use their money changes. And again, aside from the really fantastic rate of return that you can get from, obviously, if you pass away, that your family can get, I mean, that's really substantial. That is exactly like winning a lottery ticket, as you said, picking the winning lottery ticket. But aside from that, you have this known solid rate of return that's just going to chug along. And you don't have to pick and choose what you're going to do or wait till you're old, way older than you want to be, to use the money. So, and this is the other thing, and I mentioned in a previous episode that I have to bring up again. I always kind of chuckle because I know a lot of people that all their money, just like you said, all their money aside from what they spend goes into a 401k or IRAs. They tend to, I have plenty of friends that do this. They max out their 401k, or they put in as much as they can. Maybe they'll max out their Roth IRA, and then everything else they're spending. So they're doing quote unquote the right thing by saving for retirement. And these are the same kind of people where if I told them about a whole life policy, they'd look at it and they go, that sucks. The rate of return's terrible. It's, minus 50% the first year. But they don't realize that in the first year they have access to $10,000. How much money do they have access to of what they've put away so far in these qualified plans? None.
Yeah.
They can't. So it's funny, people get hung up on that, but they're putting money in vehicles that they can't access for decades anyways. So it's kind of nonsensical, really, when you think about it.
Well, and I think back to what seems to be, I don't know if I should say it's human nature, but it is the nature of beings right now, which is if a lot of other people are doing it, then that must mean that it's even though I have a little uneasy feeling about it. Maybe, people might have that inside them, but they go, yeah, but everybody I know is doing this, so it must be okay. And then if you're sitting here listening to this, hopefully that's what we're doing, is kind of just getting you to think a little bit about, did I ever think like that? And if I do or did, really, I'm in the same boat. It's tied up. I don't have access to really any of it. And if I do, then I am set into term payments, payment terms, sorry. And, and how soon I have to pay it back and all that kind of stuff. And I'm limited on what amount I can take. Right. And so you're no better off. In fact, you're worse off. I mean, that's how I'll say it. I'll kind of leave it at that. You're really worse off because you don't have all that flexibility.
Amen.
Amen. All right. All right. Thanks, everybody.
Yeah.
Please follow us, on your favorite podcast. If you haven't already. And we'll be here again next week. So thank you for listening.
Thank you. And John, thanks for this fun idea. This was good food for thought, and I liked chatting about it.
Yeah, same. Thanks, Doug. You're always accommodating, like I said. So I really and encouraging too. So thank you.
Yeah, man, you got it. We'll see everybody next week.
Okay. Bye.
Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.